Everyone loves NVDY for its monster yield. But should you reinvest those dividends or take the cash? I backtested $50,000 in NVDY using three strategies: 100% drip, 50% drip, and no drip at all. The results completely change how you might want to invest in this ETF, and they're not what most people expect. So stay tuned. Welcome back to Simply Money. Today we're looking at NVDY. We're going to be looking at this and backtesting it on $50,000 invested on June 7th, 2023, and how it's performed up until October of 2025. We're going to look at three scenarios. We're going to look at backtesting it with 100% drip, meaning we've just been accumulating, buying more shares, and just dripping all of the distributions back into it. We're going to do it with a 50% drip, where half of the distribution is buying more shares, and the other half is being used for cash, whether it's for spending, expenses, or it's investing into something else. It's just not going back into NVDY. And then the third scenario is where we do zero drip, and that cash is coming out being used elsewhere. The reason we do these, I've done this on other videos for other funds. It gives you an opportunity to see how funds that are focused strictly on income versus those who are focused on income and growth. And you're going to see the difference with some of these, how you have to reinvest some of the distributions to maintain your balance. Others you don't need to. There are funds out there that growth is their primary focus and then income is secondary, and they're still producing high yields, just not these 70 and 80% yields that you see with Alti and other funds. With that said, let's dive into our spreadsheet and look at some of these numbers and the data and see what we find out here. June 7th, 2023, the share price was $22.17, or $50,000. That buys us $22.55 on shares. 2,255 shares is what we start out with. This is a monthly paying distribution. It pays out once a month, and we have those distributions again from June 7th. And I know there's first things people are going to say, oh, if you bought on June 7th, you're not going to get that first distribution. We can go back here and let's just do that. We'll put the 5th, change that up there. But now our share price starting out was $23.69. We have 2,111 shares. We were in before the ex-dividend date. You get that first distribution. That way, those who are saying I'm cherry picking, I just had to backdate it 2 days and we're good to go. So here's the starting share price. Let's start on this scenario. Let's start by going down the share price, because I want to focus on this first, on this fund, because this brings up a strong point that you hear about a lot right now with Alti. As of recording of this video, I think it's down to about $5.20, and it has some people panicking, saying, see, it's lost so much value. There's no way you're going to make money on this. And one of the issues I have, first of all, is anytime you're looking at investments and you're looking at 1, 2, 3, 4 months and saying, see, it's not performing, that is a short time frame. That is not a way to measure something's success. This, at least we have 28 months. We're looking at 2 years and 4 months worth of data here. So we have a little bit more data to go on, but even in investing, this is still a small time frame. A bear market can last 2 years, a dot-com bubble, a housing market crash. Those types of markets can hit and cause really bad markets for a long period of time. 2 years is not like a long period to look at data. Even with that, take all of this understanding that we are looking at long term. We're looking at 5, 10, 15 years of what we're hoping for and what we expect things to do. With that, let's look at these share prices. We see that we got in at $23.69. Those buying in, we'll just scan down column B here. It stayed around $22, got down to $21.10. And I could see some people probably here starting to say, oh, the NAV is eroding on this fund. It's no good. What's going on? And then a couple months later, now it's up to $28, almost $29. And those same people are probably going to jump in and say, see, it's a growth fund. It's not an income fund. You're going to have that. The market is fluid. It goes up and down. It has fluctuation. Just in this year, Not even a year, you have that going from 23 down to 21 up to 20, almost $29. And you can see again, it starts dropping down, gets all the way down to $20.96 here. And we go down a little further, it starts back up to 26. But look where we're ending up as of October. I want you to look at this carefully. Now, we got down here to $14, but currently in October, we're down to $16.47. So from $23.69, it sunk and then went back up to almost 29. Then it began sinking back up a little bit, but it's down to 16.47. If you look at this on the surface, if you're just looking at a share price graph, it's going to look horrible. You're going to see this decline, and that's where people look and say this is a horrible fund, but they're not looking at the total return. We're going to look at the total return in these different scenarios because the total return is different whether you're doing 100% drip, 50% drip, or no drip. We want to see the comparison depending what you're doing with those cash distributions. But with the price, look at this. Just in 28 months, it's down 25.71%. Negative NAV, this is what people don't like seeing. This is what has people freaking out. But you have to first ask yourself, it's not about NVDY. Is NVIDIA's price going down? It's about NVIDIA. Are you sold on NVIDIA? Do you feel solid about NVIDIA? And then there'll be people who say, well, then just buy NVIDIA. And that's great. If you are in it just for growth and you strictly want growth, probably buying the underlying could be, in some situations and probably most situations, a better opportunity. And we do some comparisons where we do income, like NVIDIA versus growth, NVIDIA, and we can do a side-by-side comparison of distributions and selling stocks and seeing the differences there. I'll be having one of those come out soon where we're actually comparing NVIDIA to its underlying NVIDIA. But for now, we're just looking at NVIDIA and what it can do for you. This is an income-focused covered call where you're getting paid premiums, and that is what they're paying out. And they're not as concerned about this NAV. This is where people get hung up. They see this negative 25. I want you to remember that. If you're looking strictly at stock price, what is your gut feeling right here? Throw me a comment down below. What is it you're seeing? And when you see this, what is it you're feeling? You're emotionally, when you're looking at this as an investor, you're thinking, what is going on here? Leave your comments. What does this do to you when you see just this? We're not going to look at the rest of our stuff over here. We're just looking at NVIDIA's price right now. How does that make you feel? That's the share price that I want you keeping an eye on, and keep that in mind. Now I want to look at our dividend amount, our distribution. There's a couple things we have to note here. First of all, started out at 75 cents per month, and it increased up here. We got up into 262. The first thing I want you to notice here is with this fund, it is very unpredictable, very high fluctuation. The distribution is going to range is drastic, and we'll look at the amounts here in a moment, but just the actual distribution per share is very high fluctuation. As you can see, we started at 75 cents, got up to 260 something, went down. Here we're at 90 cents, 67 cents, and it's back up to $1.63. And then here we're ending at 64 cents. But again, that you got to remember, we're down here 29%. This is going to be down, but it's still keeping that same yield percentage. And something that people struggle with seeing that the distribution isn't really getting lower. The yield is remaining pretty constant in the sense of where it's at compared to the share price. The other thing I want you to notice here is this 11 cents. I have this highlighted in yellow because starting this week, this is one of the funds that they've gone from monthly to weekly paying. You're going to see more frequent distributions going forward starting this week. As you can see, the amount is smaller, but if you got that over the course of 4.3 weeks in a month, you're looking at 44 cents. It's not as low as it feels. It's still lower, but let's look at some of these things. When you look at the full drip, let's start with the full drip, meaning you're getting your distribution. This first one here, you got 75 cents and you had 2,111 shares. That pays out $1,582.95. And you're buying more shares with that at this price. And that brings your share total up to 2,182. You've gained 73 shares this month from the distribution. The next month, you get 96 cents, but it's on this 2,182 shares, so that goes up. As you see these share prices fluctuating, you're also increasing the number of shares you're holding. I want to come down here for a minute. This is your monthly income. Again, this is a $50,000 investment. With these distributions of $262 and $261, look at that. You're getting $7,500 that month, $8,197 the next month. Then it drops in half, and this is where the unpredictability of it can come in, and it's a little tougher for people trying to budget if this is all they're counting on, which I wouldn't encourage anyone to have just one fund and have all their money in. That is my opinion. You can do with that as you wish, and that's a good point. Good time to say this is not financial advice. This is for informational, educational purposes only. I'm just showing you the data, what it's done in the past, depending on how you put the distributions with the drip, 50% drip, no drip, and showing you what it did. Has no indication of what it will do. And when we forecast the future income, we're just basing it off past performance, which is not guaranteed. Now, as continuing on here, we come down, it dropped to $4,000, but then look at this, it goes up to $9,000 2 months in a row, then down to $5,000. Want to come down here though, look at this, it's down to $161. Up here you got $9,000 at a $2.56 distribution. Down here you're getting a $9,000 payment, and it's $1.61 because look at this, your share volume, you're up to 6,511 shares compared to here you were at 3,900, 4,300. You've gained so many more shares in those few months. This lower payment is still producing this high yield. And as we come down here toward the end, you can see again $1.63. It's only 2 cents higher than this one back in February, but it's $2,100 more because look how many more shares you have. Now you're up to almost 8,000 shares. You're getting an $11,000 payment this month. But you're buying more shares. Now you're up to 8,200. We'll come down here to the end, not counting this weekly payment that just came out. We'll get to that in a minute. Looking at October 9th, the last monthly payment was only 80 cents, but it still paid out $7,658 because you have 10,000 shares. You started out with $50,000, June of 2023, 2,000 shares. Now you're up to 10,109 shares. You've gained 7,998 shares. Your distributions have equaled $161,000 that you've used to buy more shares. And remember, when this price that we were talking about, how awful that looks. Look at this. You're getting an $11,000 payment with a $15.05 price. Look how many shares you're gaining that month. Look how you're jumping up here, 7,100 to 7,900, because you're getting this gigantic payment and you're reinvesting at a very discounted price here. That's where people don't panic about this price as long as this yield continues to provide. And look at these payments. Again, you didn't collect this $161,000. You reinvested it, and that brings your full value, your drip value. So your $50,000, you're buying more shares. You can see how it grew month over month. You had some dips here, but still, this is where I want people to see. Right here where the market, you're looking and saying, oh, it's down to $20.96. We'll highlight this right here, $20.96. And you're kind of having a panic mode. The NAV's decay and blah, 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 all the naysaying that you hear. You're getting a $6,000 dividend payment, but look at this, your balance is $101,000. That is just over a year from when you started this, $50,000. So if you were to say, okay, the NAV's decaying, I'm going to go ahead and sell this, you've doubled your money in just over a year by reinvesting these distributions. You're down. Yes, you're down from where it was a couple months earlier at $118,000, but you're up $51,000. You can go ahead and sell and say, oh, I'm getting out of this. This sucks. This is no good. This is a horrible fund. The NAV's decaying, all those things. But look what happens if you waited another month, you're up to 125. You would have got back higher than you were when you thought, oh, now it's dropping. You're back up to 125. Then look, the next month, 136, 136. And it's come down here to the end, not counting, again, this weekly distribution. We'll get there. But the last monthly distribution, if you said, okay, this share price is horrible. It's down from $23.69 to $16.47, but I'm at $165,000 portfolio balance. I can sell out of this position. Or I can say, okay, I'm going to go ahead and hold, and I'm going to start taking these distributions and spending them. And so this might deteriorate a little bit. This might decline a little bit. And that's where we use the hybrid, where we go to a 50-50. And that's what we're going to get into next. But I want you to see that. This decay, 29% down, you're still up $107,000 in a matter of 28 months off a $50,000 investment again, because you're reinvesting these distributions. NVDY has performed tremendously because NVIDIA has done well. The underlying has done well. This does not matter in the sense of how people normally look at share prices. You have to remember that, and we'll look at our total performance when we're done looking at these other scenarios. Other scenario, 50% drip. For those who are new and you haven't seen one of these before, how we do this is you're taking your distribution, this full distribution of $1582.95, half of it is $791.47. I put the half amount here because you're taking half of it, this $791.47, and you are reinvesting it. You're buying more shares of NVIDY. You're also taking $791.47 and spending it, buying other shares of some other fund, using it for bills. This is the amount that is reinvested, and then also the amount that you're getting to spend on something else. 50%. As you go down further, you'll see it doesn't stay 50% of this because you're buying fewer shares. So 50% is based off the share numbers that you have. The only time it's purely 50% is this first month where you have the exact number of shares. But as you're going down here in the full drip, you're buying more shares, twice as many, because you're buying 100%, where here you're only buying 50% of the money into dividends, using it for more investment, more shares, so you are getting fewer shares. As we come down here, let's look at this 11,000. Look here, you're only getting $3,197. You can see how it exponentially grows as you're buying more and more shares. Okay, so let's look at this and see how this differs. We'll come down here to the bottom. You can see that you have gained $53,713 that you have gotten in distributions, and you have reinvested that into more shares. So you've gained 2,564 shares. Not bad. You've more than doubled your share quantity, but also remember you've received this amount in cash. You've spent $53,000 reinvesting, and you've received $53,000 that you did not reinvest into NVIDY and is somewhere else. Maybe it's part of a savings account. Maybe you've been spending it on bills. Maybe you've invested it in some other fund. But there's $53,713.13 that has been given to you that has to be counted toward the total return. And we'll look at that again in a minute when we add up total returns. But our share price, again, this isn't going to climb as fast because you're not getting this huge growth in share quantities that you do with the full drip, but still not bad. 28 months, you have a $22,828 value increase in your portfolio. You're up from $50,000 to $72,000. Plus, you've spent $53,000 in income over 28 months. Not too bad. If you add those two together, that gives you your total return. Now, the third one we want to look at, and we're going to get to the full total returns here in a second, so bear with me. Dividend payment, zero drip. This is constantly going to be whatever your dividend amount is multiplied by the number of shares you bought, and you're never adding more shares. You're not buying or selling. This is your share total from start to finish in this scenario. You get your dividend, your distribution, and you use it how you want. This is maybe you're living on this. This is your supplement to your income. And so you have this monthly income, $1,500 here, $2,000 a month. And this is where that inconsistency can be tough because you start out getting $1,500, $2,000, then this month you only get $865. That can be tough if this is your sole source of income. This is a nice way to supplement income using these covered call ETFs, but you have to remember that they fluctuate a lot. There's going to be a reason we're going to look at possibly not doing a zero drip. Maybe we don't do a 50% drip. Maybe we do a 25% drip. All funds are a little different. We have a spreadsheet that we use that kind of shows different scenarios. You can check that out on the reinvestment tracker spreadsheet. All our spreadsheets are available on the Buy Me a Coffee link down in the description. If you like these and you want to play around with them, feel free to grab one from there. But this is just showing you how this adds up. And this is based on past performance. If you had bought $50,000 in June of 2023, these are the dividend payments you would have got each and every month since that day. As you come down here in some of those higher payments, look at this. That's not too bad for a $50,000 investment, getting $5,000 a month, $5,000 $2,500, $5,400. As we come down to the bottom, 28 months later, you've received $74,000 in distributions. That's pretty good. But with no drip, because this share price has dropped 29%, your value has dropped down to $32,800. And this is where people get caught up. They think, oh, it's an income fund, so I'm taking all the income. And you may want to do that. That's up to you. But if you're taking all the income, yes, you may see your value decrease. But if you drip some of it, like we did in the 50-50, you're still getting a really healthy distribution, which is growing as you're buying more shares still, and your portfolio value has gone up. Maybe you with this at 72,000. So maybe if you did a 30% drip, would have to play with it on the calculator. But if you did a 30% drip, perhaps you're still lingering around that $50,000. Maybe that's your goal. You want to maintain this $50,000 in perpetuity, and you keep dripping enough to keep that balance, and then you take the rest as income. With this here, you've taken all the income, you've gotten your initial investment back, plus $24,000, and you still have $32,000 in the portfolio. Again, it depends on your goals. If you're doing this as a bridge account and you say, I'm retiring at 60 and I need 2 years of income, and you don't care if this little portfolio, this little fund gets depleted, as long as it's generating income. Some people do it for that. Other people want it long-term for 30 years, so they do more of a hybrid approach. Others, like myself, are in the accumulation stage still. So with my covered call ETFs, I use the full drip. I'm buying and accumulating more shares, so when I turn the drip off or hybrid it, I have a lot more shares to begin to draw my income from. That is the three scenarios, and let's look at the final outcome. With a full drip, our value is what it is. $107,000 increase, 214%, because the value is in the portfolio. That's everything, because all distributions have been reinvested. That is your full drip and balance. Now with the 50-50, we have to take 50% of the distributions that we've taken and we've put elsewhere, and we have to add it to the portfolio balance. So this $22,000 increase plus this $53,000 distribution that we've spent gives us this $76,000, and that is our gain, total return. This is our total return here in these three scenarios. Still excellent, 153%. Over 2 years and 4 months, 28 months, 153% return. Nothing wrong with that. Now, even in this scenario, no drip, you have to take your distributions, which have received $74,000, but in this case, you have to subtract the $17,000 that you've lost in your portfolio, and that gives you your total return of almost $57,000. As you're looking at this, same with this NAV price, these negatives, these reds, that's where people panic, people freak out, people get all confused or upset, and I'll get some of the comments here now, and that's fine. Leave me your comments, questions, and concerns so we can dialogue about this with the community. There's been some great insight. Some of the viewers, you guys provide awesome insight to each other. I appreciate that. Appreciate the explanations and the questions that help dig deeper into what it is we're trying to accomplish. You have to subtract that, but you still had a total return. Your $50,000 28 months later has gained $56,986. You have more than doubled your money in 28 months. There is nothing wrong with that in the investing world. Even in this scenario, you have to look at that. But what you're doing with this is your business. The distributions have to count toward your total return. Make sure you remember that. Do you have any questions on this, the total return? Is there anything on this spreadsheet you want to see different or you're not understanding? Please feel free to throw a comment down below. I do my best to answer every question, comment, and dialogue with you guys. I appreciate the support. You guys have been awesome supporting the channel. Keep throwing in your suggestions for other videos you want to see. I like producing things that you like because it gets more dialogue, more interaction with you, and that's what I'm here for, is to provide you information that you're looking for. I do appreciate you joining me. This has been NVDY, 3 different scenarios, total return, and how you deal with it and how you want to use that money and your income, your growth. But don't confuse a growth fund with an income fund, and understand that sometimes an income fund has to be reinvested a little bit if you want to maintain this balance, but you're still getting a healthy distribution. What it does is it gives you more control. If you want to use the money for expenses or if you want to take the money and buy more of the same shares when they're on sale, or you want to use it to build up other positions. It gives you more flexibility this way. And that is one reason people do this over pure growth funds. And I understand some people don't get that, and that's fine. Everyone has to make their own decisions because, as we say all the time, personal finances are personal. So thank you for joining me. Don't forget to hit that like and subscribe button, and we'll see you next time on Simply Money.